Hello and welcome to the day ahead. It is Monday, March 14th. I'm Andrew Gagan. Well, let's begin in the US. Equities retreating again as volatility grips the markets. Wall Street deep in the red as the war in Ukraine and spiking oil prices continue to stoke concern economic growth and corporate profits could slow. It comes amid reports talks between the two countries are taking place and will continue tomorrow, with both sides saying some sort of agreement could come in days. However, the US has warned that Putin is still out to destroy Ukraine. Well, rumours of a possible positive shift in talks sent European equities higher to end the week. The FTSE up nearly 1%, while the volatile German DAX managed to spike to a week high before trimming gains. The ramifications of the sanctions are keeping markets off balance, with investors nervous with the uncertainty of Putin's endgame. This as the US and G7 hit Russian trade in the latest retaliation, with the EU saying it's doable to cut dependency on Russian oil and gas by around 2/3 by the end of the year.
With that bipartisan cooperation, I'm looking forward to signing into law the bill revoking PNTR, which is, again, most people think it as most favored nation status. We're also taking a further step of banning imports of goods from several signature sectors of the Russian economy, including seafoods, vodka, and diamonds. And we're going to continue to squeeze Putin. The G7 will seek to deny Russia the ability to borrow from leading multinational institutions, such as the International Monetary Fund and the World Bank. We're banning the export of luxury goods to Russia. They're also the latest steps we're taking, but they're not the last steps we're going to take.
Nearly half of Russia's reserves are frozen, with the Kremlin saying yesterday it's counting on China to help it withstand the economic blow. In response to the West's continued sanctions, the IMF says a Russian default on its debts is no longer improbable, however says it won't trigger a global financial crisis. Well, sticking with the bigger picture, the pound moved marginally higher against the euro after a positive GDP read in the UK for January, though it fell against the greenback. The Australian dollar has taken a tumble, down some 1%, breaking below the 73-cent handle. And on the data docket, quiet, with the University of Michigan Consumer Sentiment Index dropping to a fresh record low of 59.7 for March. Looking ahead, it's all eyes on the US Federal Reserve, with the March meeting this week a live one. While the market has pulled back from its expectations of a 50 basis point hike, 25 basis points is nearly 100% priced in by the market. The move will be the first rate rise since 2018. The all-important dot plots will be the focus after December's release showed a mean expectation of 3 hikes this year and another 3 next year. For analysts, the risk is for the Fed not sounding as hawkish as the market expects them to be. Elsewhere, the Bank of England tipped to hike the official interest rate 25 basis points for a third consecutive meeting, while the Bank of Japan is widely expected to remain on hold as inflation in the economy is far less of a concern than it is for its global peers. Relatively quiet in the US on the data tape. Retail sales, producer price index, and a raft of housing data all released this week. We'll bring it all back home. And SPI futures setting up for a positive start to the trading week, up around 0.3%. Oil again higher. Brent crude flirting with the $113 a barrel handle, while crude was up 3% to near $110. Iron ore took a hit, down 2%, with ADRs of BHP and Rio down nearly 4% and 3% respectively in New York trade. Turning to the political arena, Prime Minister Scott Morrison has continued to lose ground in the polls, now level with Anthony Albanese as preferred PM. The latest news poll comes just 2 weeks out from a key pre-election budget. And to the week ahead here at home, it's all about jobs data. The February unemployment figures hitting the wires on Thursday. Forecasts are for some 40,000 jobs to have been created in the month, with the part-time rate holding steady at 66.2%. The jobless rate is expected to drop to an all-time low of 4% in the month as the economy continues to rebound from a COVID-induced slump. Elsewhere around the region, focus will be on China, with retail sales data released tomorrow. Forecasts are for a 3% year-on-year rise, an improvement on January's print. And that is your day ahead. See you again tomorrow.